Well, welcome everybody to The Biz. My name is Eric Palmer, and part 2 of our series with Bob Ritter is going to be focused on something that I think is really important, which is taking a look at those illustrations that we produce with Index Universal Life and answering the question that we get quite often, which is, why don't I just buy term and invest the difference? Now, we've heard that quite a bit, and for those Susie Orman followers out there, I think that we've had some individuals even subscribe to that doctrine, but Bob, you've put together one of the parts of your software to specifically address, the individual that asks the question, well, this is great, you want me to put $20,000 into this Index UL, but I can buy that same amount of life insurance for $600 a year. How do you answer that question? How do you address it? I'm going to pull this up real quick, but walk us through this particular example because this happens nearly every single day to a producer.
Well, you hear so much about it. Typically, the reaction is, why would you spend $19,400 in that example that you don't have to? It's got to be just a terrible thing to do. And you hear that in a lot of places.
Right.
And I'll tell you this, Eric, there's no valid economic theory that explains why a bad idea is good just because you hear it a lot.
Right.
And you do hear it a lot.
Right.
But you really need to address the mathematics of it. If I'm going to buy permanent insurance, Index UL in this example, or I could buy term, that difference is investable, assuming I do it. Lots of people don't, but assuming I do it. What does it grow to? So if you compare $20,000 into a life insurance policy, let's say this George Brown over 20 years to retirement, versus the $600 on a 20-year term, forget the fact the term runs out.
Right.
What do you build by doing that? And it's a very easy comparison to do. You take the difference in premiums and you invest them. The value of the taxable account here, for instance, by the 10th year is $238 after tax. We've got him in a 30% tax bracket at a 7.5% yield on the taxable, which is pretty generous.
Right.
Life insurance policy at that point has $882,000. This thing's starting to run out of gas, and it does run out of gas, I think, in the 37th year.
Right.
And of course, there's life insurance on top of it. But forgetting that, long range, you can draw just about $1 million out of your taxable account. And you can get almost $1.8 million out of your life policy, and it's still cooking.
Well, I think something important to point out about this is that, first of all, human longevity, it's not shrinking. We're living longer, and in fact, I came across a book. An individual did a study on individuals that are exceeding, the centurions, exceeding age 100, and he did an interview with an individual that was 115 years old. So I think that's a testament to the fact that, first of all, buying term that's going to run out in 20 years, well past the need
30.
point, or 30 years if you're able to purchase it, isn't necessarily even to get you to life expectancy. So when the coverage is gone, now the insurance aspect's off the table. You spent the money for nothing because essentially the term insurance is completely gone. You funded less than into your retirement account, therefore getting less income and losing a year. If you remember the previous series, if you watch part 1 here, we had the individual running to 38 years of income. Here we actually even lost a year because of that type of a difference. You're spending a little bit extra on the term insurance itself. So I think the important message here is that not only is the idea of buying term and investing the difference something that doesn't even necessarily work. What do you choose to invest in, right? And if you lose that money, what was the point of buying the difference? But also that you're still getting the death benefit coverage and extending your income out using a permanent life insurance policy.
If you don't have the cash, you got to buy term.
Right.
But if you got the cash flow to buy what you want, you're out of your mind to buy term insurance.
Well, what would you say to a producer that is sitting across the table from somebody that has a 401k that they're maxing out, for example? So we've got the qualified plan. We know the broken mechanics of these qualified plans. And they already have some term life insurance. And you're sitting down as an advisor and you're trying to talk to them about potentially allocating a portion of that 401k or the additional funds perhaps that they're thinking about investing into an IUL. And they say, well, I already have term insurance. I already have this death benefit coverage. How can we take this illustration and try to make the story that we can either replace that coverage? What would you suggest that they do with that
whether
situation?
you buy it fresh for $600 or are already paying $600 for it, doesn't make it any better either way.
Right.
You just buy the permanent insurance. Just drop the $600, and you're spending more, but you're gaining a ton more, as you can see,
right.
A ton.
So this particular one-pager, in combination of the one that we looked at in the first episode, would be a powerful two-punch combo. So we're showing the individual why putting the additional money in the life insurance is going to outperform that potential qualified account. And then we're showing them why the idea of what they're spending on the term insurance isn't necessarily answering the problems that they face. Right. Individuals are always going to inherit something, right? So, or at least we hope they will. So is the asset taxable that we're transferring on? Are we passing through qualified accounts to our spouse, who then is going to pass that on somewhere else or take those taxation out? We got to start asking those questions and bringing those points up in these appointments when we're sitting with these clients, because that gives you the transition into a one-pager such as this. And of course, we have the backup to this, right, Bob? So when the CPA gets their hands on it again and says, okay, well, let me see the hard numbers, the Insmark software will give you this output. And if you want to walk us through this just real quick.
It's a swamp of numbers if you look at it, but it reads just like a book. Pay 20 or pay 600. If you pay the 600, you can invest the 19,000. If you invest the 19,000, you develop that column of values right there. Which one? This one right here.
Right.
The red. Now, buy term and invest the difference is a good idea. This column should be higher than this column.
Right.
And it's not close.
So we can read this by going, look, if it's in the red, first of all, that's an area that's flagged. We got to pay attention to these numbers. So if the theory of buy term and invest the rest is right, from what you're saying, this would be green. We would see this column outperform this column, and it's just not doing it in this case.
Well, you will over a very short term. And this is not designed to force the sale of life insurance. If you're buying it for a very short period of time, a debt that's going away or whatever, this thing will tell you to buy term.
Okay.
So it's pretty objective.
So it's really truly answering the question without having a bias towards an insurance product. That's powerful to me, because at the end of the day, we're salespeople, right? And when we sit down with clients, they know that we're salespeople, so we want to give them facts, and our facts need to be reinforced with mathematical logic, and that's what you've done here with this program. Well, I think the takeaway from this particular episode is that, first of all, it doesn't just end with telling the story about why cash value life insurance is a stronger option than a lot of what we have out there today, but also helping address those objections that not only the consumer comes up with themselves, but quite often it's their fiduciary or their CPA, somebody that says, I don't think that's necessarily the right move. You have the math, you have the backup, and you have the ability to tie it together. Anything else you want to comment on about this particular subject?
No, this is it.
It's a slam dunk. It's pretty cut and dry.
Yeah.
Well, thanks again, everybody, for taking a look at today's series. I think it's really interesting that we have these types of tools that can address the questions that we come across so often. I think you mentioned it in the first episode, Bob, that the reason you got into this is because you didn't necessarily like the material that the insurance companies were putting out. I think that this gives us a neutral way, without an insurance brand attached to it, of showing the math and showing the logic. So again, if anybody wants to take advantage of this type of a presentation, get your hands on the Insmark software. I think you're going to really enjoy the different concepts that it will provide. It's going to help advance your practice, and it's going to make sales a lot easier to make for you going down the road. So if you want to get your hands on this, just write us right here at The Biz. Our email address is right at the bottom of the screen. You can give us a call as well. Request the special opportunity that we have for our Biz members to get your hands on the Insmark software. Thanks so much.